Hi. Let's learn about cash flow from operating activities, CFO, the amount of money a company brings in from its ongoing, regular business activities. Cash flow from operating activities indicates the amount of money a company brings in from its ongoing, regular business activities, such as manufacturing and selling goods or providing a service to customers. It is the first section depicted on a company's cash flow statement. Cash flow from operating activities does not include long-term capital expenditures or investment revenue and expense. CFO focuses only on the core business, and is also known as operating cash flow, OCF, or net cash from operating activities. Cash flow forms one of the most important parts of business operations and accounts for the total amount of money being transferred into and out of a business. It allows business owners and operators check where the money is coming from and going to, maintain sufficient cash necessary for operational efficiency, and make financing decisions. Positive cash flow from operating activities indicates that the core business activities of the company are thriving and provides an additional measure of profitability potential of a company. The cash flow statement is one of the three main financial statements required in standard financial reporting, in addition to the income statement and balance sheet. The cash flow statement is divided into three sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. These sections provide a picture of where the company's cash comes from, how it is spent, and the net change in cash resulting from the firm's activities during a given accounting period. The cash flow from operating activities section can be displayed on the cash flow statement in one of two ways. The first option is the indirect method, where the company begins with net income on an accrual accounting basis and works backwards to achieve a cash basis figure for the period. The second option is the direct method, in which a company records all transactions on a cash basis and displays the information on the cash flow statement using actual cash inflows and outflows during the accounting period. Different reporting standards are followed by companies as well as the different reporting entities, which may lead to different calculations under the indirect method. The CFO value can be calculated by two main formulas, both yielding the same result. The first format is used for reporting cash flow details by finance portals like MarketWatch, while the second format is used for reporting cash flow details by finance portals like Yahoo Finance. The net income figure comes from the income statement. Since it is prepared on an accrual basis, the non-cash expenses recorded on the income statement, such as depreciation and amortization, are added back to the net income. Investors should be aware of how working capital and capital expenditures can impact the cash flow from operations. Here are 5 key takeaways. 1. Cash flow from operating activities is an important benchmark to determine the financial success of a company's core business activities. 2. Cash flow from operating activities is the first section depicted on a cash flow statement, which also includes cash from investing and financing activities. 3. There are two methods for depicting cash from operating activities on a cash flow statement: the indirect method and the direct method. 4. The indirect method begins with net income from the income statement, then adds back non-cash items to arrive at a cash basis figure. 5. The direct method tracks all transactions in a period on a cash basis and uses actual cash inflows and outflows on the cash flow statement. Hope this would help. Thanks for watching.